Hi guys, welcome to Compound and Everything. My name's Chris and this is the channel that discusses all things investing, finance and business. If you haven't already, feel free to click that subscribe button and the little notification bell next to it, which will keep you up to date on all of our latest videos and market moves. In this video, we're going to be discussing one of the most divided, opinionated and intensely disputed stocks on the ASX with one single goal in mind, trying to understand if Afterpay is a buy or a sell. So, stick around. There is absolutely no doubt that Afterpay has been on the lips of Australian investors since hitting the market at $2 a share and reaching heights of $40 a share within a 24-month period. But of course, before we can truly judge the fundamentals of this company, I think it's only fair that we strip it back to its bare bones and understand what is really going on under the hood. The easiest way to do this will be by breaking up my analysis into three different groups. The first, the product, the second, the company, and third, the books. So of course, we're going to be kicking it off with the product itself. There is absolutely no doubt in my mind that Afterpay is the market leader in buy now, pay later, instant gratification type transactions. Offering their product in 40 countries around the world, led by Australia, the UK, and of course, the most recent addition, the United States. But how did all of this start, and how are they allowed to give people money without being licensed to do so in such highly regulated countries? Well, the answer is kind of simple, but complicated at the same time. Afterpay don't consider themselves to be a lender. Buy now, pay later providers don't have to operate under the same rules that traditional credit providers do, because their offerings aren't captured by the National Credit Act, especially here in Australia. So you might sort of think, how is that possible? How are Afterpay not considered to be a credit provider? Well, Afterpay don't actually charge interest or other costs to customers. Instead, it collects a purchase cost on behalf of the retailers over 4 equal fortnightly payments. The idea itself has been adopted in the past, but never to a scale like Afterpay has shown in recent years, growing at rates that are literally unheard of here locally, with 2.2 million users on their service in the first 3 years. They have also had to negate a minefield of legislation, bypassing things like credit checks and dull application forms. However, it wasn't just the legal team that had to work hard here. Afterpay founders also had an eye for detail while perfecting their software through a very smooth and easy to use application. The app itself is a hub for all things client facing. You can check your balance, generate in-store barcodes, and make repayments on your account. Some of these functionalities are also available on the website itself, which will be discussed later in the video in more depth. Like I said, this isn't the type of product we're used to seeing locally here in Australia. It has that, I don't really know how to word it, it has that high-end USA type vibe attached to it. The user interface is flawless, easy to use, and creates a simple experience while buying products in-store or online. Afterpay has created an exceptional piece of software. The development, design, and creative team should give themselves a pat on the back for achieving this in such a short period of time. So look, we've pretty much covered the product itself. There is only one step left to do in regards to the product, and that would be you smashing that like button and helping me out with the YouTube algorithm. Okay, but seriously, the next step is the company itself. Often surrounding Afterpay are the negative connotations of how they make their money and should they have to adhere to lending regulations locally here in Australia or even abroad. Anybody that happens to have been a shareholder of Afterpay in the past or followed the stock would be aware of how many lawsuits and investigations Afterpay has faced in its short history. Within Australia here locally, they've had to battle the Reserve Bank of Australia in a bid to avoid regulating their fees. While in the United States, they've already had to settle with the Department of Business Oversight, which is California's financial regulator, to the tune of $1.5 million. Part of this settlement was refunding late fees to client, while another was administration fees, whatever that happens to be. So having said that, I guess the appropriate place to start here would be talking about how they make their money and if it's ethical or not. As per their last report, Afterpay's revenue is roughly $250 million. That income is broken up into two categories. The first is late fees, which make up roughly 18% of income. So listed on their website, these are the current fees for late payments for any Afterpay clients. If a payment is not processed on or before the due date, late fees will apply. An initial $10 late fee and a further $7 if the payment remains unpaid for 7 days after the due date. For each order below $40, a maximum of $10 late fee may be applied per order. For each order of $40 or above, the total of the late fees that may be applied are capped at 25% of the original order value or $68, whichever is less. I'll be frank with you here, I was shocked at how little income was provided to Afterpay via late fees. Not to mention how their fees are reasonable in comparison to most other lenders or buy now, pay later providers. Not only that, it's unique for a provider to charge whichever is less instead of whichever is greater. That is something that is very unusual in the finance world. So for whatever it's worth, that is a little tick in the ethics box for Afterpay. And from a client-facing perspective, there's only one red flag that I can find in this process, which is no credit checks. Most users are probably very happy about this scenario. However, I do think that the credit check system, although somewhat flawed, does have its place in protecting users against themselves, creditors, and bad debt. I guess this is slightly mitigated by Afterpay's lower account limit, which seems to be anywhere between, from memory, $300 and $1,200. It would be reasonable to say that Afterpay doesn't appear to be overly interested in your late fees. In fact, I'll go as far to say that they're probably leading the banking industry in this aspect, even though technically they aren't a member of that club or even regulated. I mean, go figure, right? The guys that don't need to follow the playbook are doing a better job at being fair to their clients than the ones that do have to follow the playbook. This becomes overwhelmingly obvious when you look at their client retention and repurchasing rates. With most clients using the service 23 times per year, and the majority of them not actually incurring late fees at all. Like I said, these fees only cover roughly 18% of Afterpay's revenue. So where exactly are they making the other 80% of their income? Well, as many of you may have guessed, this comes down to the retailers themselves. For those that have had a business EFTPOS machine in the past, you'll know all too well they aren't cheap. You often end up paying anywhere between 1% and 3% for Visa and MasterCard transactions. So we'll use those fees as a comparison in this example that we're about to make. According to finder.com.au, Afterpay is charging retailers a flat fee of 30 cents per transaction, plus a commission ranging between 4 and 6% depending on their individual agreements. In saying that, while completing my research for this video, it appears to be much closer to 4% in almost all scenarios, which is still a little high. Unlike the client-facing fee structure, I'm not overly sold on the 4% fee Afterpay are offering retailers. This is higher than I've professionally experienced as a business owner myself, and I mean, 4% is a large chunk of any transaction, especially if a business might rely on high turnover of stock with lower margins. In their defense, it could be argued that Afterpay are potentially exposing these new retailers to clients they may not have had otherwise. The best evidence I could find showing this might be the case was reviewing the traffic that Afterpay receives every month on its website. The website itself is a very large catalogue of all retailers using their service at this point in time, which is roughly 30,000 retailers. As you can see here locally, over 500,000 users are accessing that database monthly. We can gain an insight into Afterpay and their competitors by using search traffic estimates. Currently, the competitors in this space appear to be Klarna, Zipco, QuadPay, and Latergator. This graphic shows the current online dominance of Afterpay's market share on Google. The closest competitor at this point would be Klarna, followed by Zip. None of their competitors in the sense of revenue or online presence are remotely close to achieving the same results. However, it doesn't just stop there. One of the standout elements to Afterpay's success so far has been its exponential growth. reaching over 2.2 million users here in Australia and growing the United States following by 3.6 million active users in the first couple of years. And most of you might be thinking, well, is this sustainable? And truthfully, the answer is short term, probably yes. However, in the long term, perhaps not so much. So using this data, maybe we can find an eye into the future. Let's take a look at traffic volumes for the website in Australia, United States, and the UK. First, Australian traffic appears to be reasonably consistent and slightly increasing over time. Further abroad in the UK, we can see since 2018 there has been growth, however it's not at all comparable to Australia. Which brings us to the United States. Since around June of 2019, traffic seems to have increased exponentially via their website. This might be an indication of an increasing user base, which can only really be confirmed in the next report. Between 2018 and 2019, they saw a 400% gain in the US alone, which I could really see being replicated if these numbers are anything to go by. So we've covered the product itself and now the company. Both have shown incredible results backed by a loyal customer base and rapid growth. And now I guess it's time to dive into the books and truly discover if Afterpay should make up a part of your portfolio or not. At the end of the day, as a long-term investor, you always care about the product and the company. But unfortunately, without the glue that is the fundamentals holding it together, you really cannot seriously consider it as an investment. According to their last report, Afterpay had an underlying sales amount of $5.2 billion, which was an increase of 140% on the previous year, resulting in 2.6 million new clients and 16,000 new active merchants. From this, Afterpay earned an income of $251 million. However, like previous years, they are still running at a loss of roughly $42 million. Meaning that they're making $250 million, but spending almost $300 million every year, which really isn't an ideal situation to be in, mainly because it's incredibly unsustainable. In saying that, you wouldn't have to go far in this space to see almost all competitors in the same position. This doesn't mean they'll run at a loss permanently, however, it does mean that right now they are running at a loss. Now look, it is very possible that Afterpay will show up a profit in the next year or two. But of course, the fundamental analysis doesn't just stop there. What I'm looking for in a long-term investment can really be summarized into the following points. 1, fair price to book valuation. 2, return on equity, hopefully over 12.5% for at least 5 years recurring. 3, low debt where possible. Number 4, a reasonable moat. What that means is I'm looking for something that is protecting them from their competitors. What competitive advantage do they have, if anything? And number 5, good management. These are not the only indicators I'm exploring before making an investment. Nonetheless, they are my bread and butter guides while screening the market for potential new investments. So let's break down these points here for Afterpay. In my opinion, and especially in this scenario, price to book valuation is a more reliable guide of fair value when paired with this list, as opposed to something like price to earnings ratio or PE ratio, which really requires a positive earnings per share to effectively calculate. In this case, Afterpay is running at a staggering 8.4 times its book value. This is incredibly high. In fact, generally speaking, I'm looking for a multiplier between 0 and 2 times book value depending on the company itself. So 8.4 is really a shock to the system for someone that's trying to find true fundamental value. The next would be return on equity. This is absolutely the key to finding great companies for long-term investors. If they are able to take their income and create more income on a consistent basis for their investors, then you are on track for a higher return over a long period of time. Obviously, with Afterpay running at a loss, we can't use this indicator as a positive guide, seeing a negative return on investment of roughly 10% in the financial year of 18 to 19. This leads me to low debt. In this particular situation, Afterpay itself isn't actually in a horrible position right now from their previous reports. Obviously, they are required to hold debt on their books while customers pay them back, and hopefully they pay them back on time. I guess my biggest concern here would be in times of economic recession or downturn. If a larger amount of clients were to stop maintaining their accounts, it might put Afterpay in a vulnerable position. Currently, Afterpay has an underlying debt of roughly $180 million. And look, while they're running at a loss, I just don't see this amount getting too much smaller anytime soon. Leading us to EPS, or earnings per share. Obviously, there isn't much to cover here, just like in the return on equity section. Any company running at a loss can't have a positive earnings per share ratio, unfortunately ruling them out of meeting this condition as well. The next point regarding their moat or competitive advantage in their marketplace is a highly debated one when it comes to Afterpay. I think you have a company whose model can obviously be replicated, which would make you instantly think, okay, sure, they don't have a moat or any competitive advantage. However, my alternative argument to that is bringing up the current competition again. And why haven't they been able to touch the heels of Afterpay yet? And I think that is really just because Afterpay has a superior reputation, application, and ease of use factor to it. Although you might be able to find somewhat similar features with competitors, Afterpay was the first and the best in its class. And more often than not, we see the first to arrive excelling in the field for many years, perhaps for no other reason than people trust them and are used to them. Now, of course, this doesn't mean we won't see Visa or MasterCard come into this space and absolutely blow them all out of the water. And really, only time will tell. I think it's important to point out what I've just done here when discussing the moat, which is pure speculation. There is no way around it. So the short answer is, I guess no, Afterpay doesn't have a moat, or maybe it does. You decide. But once again, this uncertainty rules them out in this part of my checklist as well. So the final point on my checklist here is good management. There is no doubt the growth of this company so far is incredible, and the management team have done a great job. I think we really covered this when discussing the product and the company. The only real red flag here has been not turning a profit yet. Although this seems to be the latest craze in large tech companies when you have Xero, Uber, and many others running a successful operation without turning any or very little profit. Afterpay have unfortunately managed to only score a 1 out of 5 on my fundamental checklist. In all fairness to them, I have seen a lot worse 1 out of 5s on this checklist in the past. There is no doubt so many have made an incredible amount of money trading this stock, and honestly, well done to you. But I wouldn't be personally surprised if it does keep going up. However, that unfortunately doesn't make it a good investment or change their fundamental position. And for solely that reason alone, they won't be finding a place in my portfolio. They're a great company, a great idea, and honestly, a really great Aussie export story. Hopefully in years to come, they can turn these numbers around, finding profitability, which might then find a home in a more long-term investors type portfolio. I would be interested to hear what you think about Afterpay itself. Maybe you don't agree that the fundamentals are that important. Maybe you already hold a position. If that's the case, please comment below. I would love to discuss with you guys what your opinions are and why you're invested. Once again, guys, thank you for taking the time to watch this video. If you haven't already, please press that thumbs up button and the little subscribe button with the bell next to it, and I'll see you again soon. Thank you.